Howdy, Jacob here. Today we're looking at telephone Ericsson, ticker symbol ERIC. Fun story before I get into financials here. This was actually one of the first companies that I ever owned back in, I think, 2019. I was looking for 5G companies when I didn't know anything about value investing and haven't heard of or didn't really listen too much to Warren Buffett, Mohnish Pabrai, all them. And I just bought companies that I thought were going to do really well based on 5G and yeah, Ericsson, Marvell Technology. Um, I want to say Nvidia, maybe Crown Castle, American Tower. Those were my initial five investments when I just started out. So that's fun stuff. But now let's actually look at the company. Done with nostalgia. Get out of here. So we see that they have an $18.9 billion market cap on $16.8 billion enterprise value. So they have more cash on hand than debt from their enterprise value. That's pretty positive. Their return on invested capital is really all over the place. In 2023, we see negative. The preceding 3 months or the preceding 3 years were actually low, mid double digits, but then 2019 was 1.8%. So we're really seeing all over the place in return on invested capital. They do infrastructure services and software solutions to telecom and other sectors. So as you know, I said they're a 5G innovative company. Maybe the innovation part was a little downplayed. They've been around since 1876, and they're headquartered in Stockholm, Sweden. They do have a 4.5% dividend yield, so that's great. That hits our standard that we're looking for. The balance sheet, they have their short term or their cash on hand roughly, or their cash on hand basically is $4.8 billion. That's going to be your short-term investments that you can just liquidate in cash and cash equivalents and such. And then their debt in total is about 4.5 billion. And so slightly more cash equivalent like assets than total long-term and short-term debt, interest-bearing debt. So that's great to see. So pretty healthy balance sheet, which is good. Free cash flow looks great. It looks like recently rolling 12 is pretty poor, actually, $400 million in total. But the preceding 5 years or preceding 3 years was crazy high, which is what we saw in the return on invested capital was pretty great. But on a 5 year average basis, we're probably looking at 1.5 to $2 billion. Let's say $2 billion is their 5 year average free cash flow about. They're paying out $888 million, so less than half of their payout. Their payout ratio is less than half. They made a huge acquisition in 2022, but otherwise their use of free cash flow is mostly going towards dividends and a little bit towards investments and intangibles and such. No repurchase of shares, it looks like, so that's interesting. And then their debt has gone from it looks like they were repurchasing debt from 2018 to 2022 and then actually issued a little bit in 2023 due to their free cash flow being as low as it was and their dividend was greater than free cash flow in that year. Really, we're saying if they can get back to their 5 year average, that $2 billion free cash flow is going to be pretty significant in comparison to their dividend. And so I think initially I'm gonna start making some assumptions here. I'm gonna say that pretty flat business, 29, roughly 30 billion in 2014 down to 25.6 billion in 2023, but up from 2016. And so, depending they don't have any huge devastations, I'm gonna say that 0% growth. So maybe they do build more infrastructure, but some of their old ones are just going to go obsolete and not really help their revenue at all. And then on the margin side, pretty average here. Like I said, I like that free cash flow is greater. That's a positive sign. They don't have so much debt. They don't have that much debt, so not too concerning on impacting margins for that. And then shares have been relatively flat. I think on the what am I trying to say? The dividend side, it's less than a 50% payout. Let's see what they've done historically. They have increased it historically, at least in the last 4 years, pretty hefty. So let's say that they increased that 3%. Maybe by the end of year 7, their payout ratio is 50 to 60%. For a business that was founded in 1876, I think that that's a reasonable amount, considering their other uses of free cash flow. But we do want to see the business buy back shares if shares get stupidly cheap. Obviously, we're not seeing that right now based on this valuation, but again, based on this valuation, we're seeing that the company stock price would have to fall 55% before getting a 15% return, given these assumptions. I think that dividend yield is safe. I just don't think you're getting much price appreciation from here. I think that I could easily see somebody put in 3% and then have margins at 8%, and then it looks a lot closer to a buy. This is just me putting in my conservative assumptions based on the numbers and the fact that the rolling 12 has been as low as it is, and revenue year over year, the last 10 years have been actually down a little bit. So hopefully everyone enjoyed the video and learned something. Has a great rest of their day. Thank you.